Imagine waking up just a few years from now in a world where your digital wallet is not only as common as your physical one, but every transaction you make, be it buying a cup of coffee or paying your rent, could be tracked, regulated, and even limited by new laws. Your financial privacy, your access to innovative financial products, and even America's standing as a global tech powerhouse could be decided this very week. The stakes have never been higher, and the world is watching as the United States Congress races to reshape the rules of digital money. But why is this happening now? And what does it truly mean for you, your family, and the future of money itself? In the echoing halls of Washington, D.C., a political drama is unfolding that rivals some of the most pivotal moments in American economic history. After months of gridlock, three high-stakes bills, the Genius Act, the Clarity Act, and the Anti-CBDC Act, are barreling toward a full vote in the House of Representatives. These bills do not just tinker around the edges of crypto regulation. They aim to redefine the very foundation of how digital assets, blockchain technology, and stablecoins will be treated in the world's largest economy. The decisions made in the coming days could ripple across international borders, influencing financial innovation for decades to come. Just 24 hours ago, the outlook seemed bleak. Congressional leaders had shot down all three bills, with nays outnumbering yays. Hopes for meaningful progress on crypto regulation were fading. But then, in a stunning twist, former President Donald Trump entered the fray. He met personally with nearly a dozen Republican lawmakers who had been blocking the bills. After intense, closed-door discussions, almost all the holdouts changed their votes. By the slimmest of margins, Republican unity prevailed, and the bills were resuscitated. In a final tally, every single Democrat voted no, underscoring how partisan and contentious the issue has become. The battlefield is clear. One side sees a chance for American innovation to flourish, while the other warns of risk, overreach, and lost privacy. Let's break down what each of these bills actually does and why they matter so much. First, the Genius Act. Picture stablecoins as digital dollars. Tokens you can send around the world in seconds, but that are always pegged one-to-one with the US dollar or US government securities. The Genius Act would set up comprehensive federal rules for these stablecoins. Only companies with ironclad reserves, meaning every digital dollar must be backed by a real dollar in the bank, would be allowed to issue stablecoins. And if a state-chartered issuer grows large enough, handling more than $10 billion, they would be required to submit to direct federal oversight. This is a big deal, because it sets a high bar for trust and stability. But it also means smaller, scrappier projects might get squeezed out of the market. Then comes the Clarity Act. Imagine if every time you wanted to trade stocks or crypto tokens, you had to guess whether the Securities and Exchange Commission or the Commodity Futures Trading Commission was in charge. That's exactly the confusion many startups and exchanges face today. The Clarity Act would force crypto trading platforms to register with the Commodity Futures Trading Commission, clarifying which digital assets count as commodities, like Bitcoin or Ether, and which ones are securities, subject to much stricter rules. The aim is to end the regulatory fog that has stifled innovation and left companies guessing about compliance. But critics warn this could just ignite new turf wars between federal agencies, creating a different kind of uncertainty. And finally, there's the lightning rod, the Anti-CBDC Act. This bill would prohibit the Federal Reserve from ever launching an official U.S. central bank digital currency, or CBDC. Supporters argue this is a necessary firewall to protect Americans from an era of total financial surveillance, where every transaction is monitored by the government. Neeraj Agrawal from Coin Center warns, the Anti-CBDC Act is vital to protect financial privacy and prevent government overreach in the digital age. Yet, on the other side, critics worry this could leave the U.S. behind, as China, the European Union, and other major economies race ahead with their own digital currencies, potentially rewriting the rules of global commerce. Why is the U.S. suddenly moving so quickly? The answer is competition and fear. China is already piloting its digital yuan in dozens of cities, and the European Central Bank is accelerating its digital euro project. If the U.S. dithers, there's a real risk it could cede leadership in the next wave of financial innovation. But if lawmakers move too aggressively, they could stifle the very entrepreneurship that made Silicon Valley a global force. Industry leaders are holding their breath. Sheila Warren, CEO of the Crypto Council for Innovation, hails the Genius Act as a critical step towards a sound regulatory framework for stablecoins, arguing it could bring institutional investors off the sidelines. Jake Chervinsky of the Blockchain Association sees the Clarity Act as the solution to the regulatory confusion that's been paralyzing American crypto startups. Meanwhile, Neeraj Agrawal and Peter Van Valkenburg at Coin Center are adamant. Without the Anti-CBDC Act, Americans' financial privacy could be lost forever. But not everyone is cheering. The threat of overregulation looms large. If the new rules are too strict or too complex, the U.S. could see a mass exodus of crypto talent and capital to friendlier shores, just as happened with the online gambling industry in the early 2000s. Then, American companies were forced overseas by sweeping new laws, and the U.S. lost out on billions of dollars in innovation. At the same time, too little regulation can be just as dangerous. The collapses of FTX and other major crypto platforms in recent years have shown what happens when rules are vague and enforcement is weak. Consumers lose billions, trust evaporates, and the entire sector suffers. The challenge is finding the right balance, a regulatory Goldilocks zone that is neither too harsh nor too lax. The stakes are enormous. Just consider this. The US dollar is the world's reserve currency, underpinning the global financial system. Stablecoins backed by the dollar are already moving hundreds of billions of dollars every year. If the US gets this right, it could cement its dominance in both finance and technology for a generation. If it gets it wrong, it risks watching the next great wave of innovation happen elsewhere. So what might the future look like if these bills pass? Let's start with stablecoins. Under the Genius Act, every stablecoin would need to be backed, dollar for dollar, by reserves that can be audited and verified by federal regulators. This could bring new trust to the market, persuading cautious banks, pension funds, and big investors to finally embrace digital assets. Imagine a world where you could send your paycheck instantly, 24/7, with no fear of your digital dollars evaporating overnight. For ordinary Americans, this could mean faster payments, lower fees, and more financial options. But there's a flip side. The bar for entry would be raised dramatically. Smaller startups, often the source of the most daring innovations, might struggle to meet the strict reserve requirements. Sheila Warren puts it bluntly. This is a big test for new players. The cost of compliance could force consolidation, with only the biggest, best-funded companies surviving. And remember, the Genius Act does not override state consumer protection laws. States like New York and California could pile on additional requirements, creating a patchwork of rules that companies must navigate. This could lead to a system where, depending on where you live, your access to stablecoins and digital dollars is very different. Moving on to the Clarity Act. If it becomes law, the endless gray area between the Securities and Exchange Commission and the Commodity Futures Trading Commission would finally get some much-needed definition. Crypto exchanges would register as digital commodity exchanges with the Commodity Futures Trading Commission, and the act would spell out which tokens are treated as commodities versus securities. Paul Grewal, the chief legal officer of Coinbase, says, efforts to bring regulatory clarity to the digital asset space are essential. Yet there's a risk that the Securities and Exchange Commission and the Commodity Futures Trading Commission could still squabble over gray areas, pulling companies into regulatory battles that waste time and resources. Jake Chervinsky warns, we may just see a new kind of regulatory chess game. The Anti-CBDC Act, perhaps the most controversial of all, would slam the door on a U.S. government-controlled digital dollar. For some, this is a victory for freedom and privacy. Peter Van Valkenburg of Coin Center argues, CBDC would pose significant risks to privacy and civil liberties. With no federal digital currency, Americans' financial behavior would remain largely shielded from government scrutiny. But critics say this could be a missed opportunity. Imagine if the U.S. could create an instant, borderless payment system that worked for every American, no matter where they lived or banked. That's the promise of a central bank digital currency. And by banning it, the U.S. could be tying one hand behind its back as competitors surge ahead. Let's consider the global impact. The world is in the midst of a digital currency arms race. According to the Atlantic Council, more than 100 countries are exploring or piloting their own central bank digital currencies. China's digital yuan is already live in dozens of cities, and the European Union is pushing forward with the digital euro. If the US fails to modernize, it could lose its edge as the anchor of the global financial system. But if it moves too fast or too recklessly, there's a risk of unintended consequences that could destabilize both domestic and international markets. There are also big questions about consumer protection. The Genius Act's strict reserve requirements could help prevent another FTX-style collapse, protecting ordinary people from devastating losses. Kristen Smith from the Blockchain Association believes, Clear rules are essential for the responsible development and adoption of stablecoins. However, the complexity of new regulations could lead to confusion, mistakes, or even fraud, especially if state and federal rules are not perfectly synced. Historical parallels abound. Think back to the early days of the internet, when a lack of clear rules both enabled explosive growth and left the door open for major abuses. For investors, the new laws could bring both promise and peril. On one hand, more stable, regulated tokens could attract big money from Wall Street, pension funds, and even global banks. This influx of capital could drive up prices and spur new development. On the other hand, some of the riskier, more experimental tokens might be squeezed out of the market, reducing choices for retail investors, but also lowering the chance of catastrophic losses. It's a classic trade-off between risk and reward. If you're an entrepreneur or developer in the Web3 space, the coming changes could be seismic. New compliance costs, required federal registration, and ongoing audits could force you to rethink your entire business model. Yet, a clear and predictable regulatory environment might also make it easier to raise money, form partnerships, and attract mainstream customers who have been waiting for a green light from Washington. The real winners may be those who can adapt fastest to the new rules without losing their innovative edge. Financial privacy is another crucial concern. With the Anti-CBDC Act in place, Americans would have stronger protections against government surveillance. Your spending habits, donations, and investments would remain private, at least from federal eyes. But there's a cost. The U.S. might miss out on some of the next-generation payment technologies that only a central bank digital currency could offer, such as instant cross-border payments, programmable money, or universal access for the unbanked. The debate boils down to a fundamental question. How much privacy are we willing to trade for the promise of greater convenience or financial inclusion? Let's also remember that the Genius Act explicitly allows states to set their own consumer protection rules. This could lead to a patchwork of regulations, where a stablecoin legal in Texas is banned in New York, or vice versa. For companies, this means navigating a regulatory maze, hiring teams of lawyers, and potentially pulling products from entire states. For consumers, it could mean confusion, or even being shut out of certain financial innovations depending on your zip code. Historically, we've seen similar patchworks, with everything from insurance to online sales taxes, often leading to frustration and inequality. Looking to history, America has faced moments like this before. In the early 20th century, the country was slow to regulate securities markets, leading to the Great Depression. Overregulation in the 70s and 80s drove financial innovation offshore, only for the U.S. to claw it back in the 90s with smart, balanced reforms. The lesson? Striking the right balance matters, and the world is watching whether America gets it right this time. If these bills become law, what should you be watching for? First, keep an eye on which companies step up to the new regulatory bar and which ones exit the market. Big players like Circle and Coinbase may thrive, while nimble startups could struggle or even relocate to friendlier countries like Singapore, Switzerland, or the United Arab Emirates. Second, watch for new products aimed at mainstream consumers. Stablecoins that work seamlessly with banks, apps that let you earn interest on your digital dollars, or even payment platforms that rival Visa and MasterCard in speed and simplicity. Third, monitor how other countries respond. If the U.S. sets a global standard for stablecoin regulation and digital asset clarity, allies like the United Kingdom, Japan, and Australia may quickly follow suit. But if the rules are seen as too harsh, the U.S. could find itself isolated, with innovation and jobs migrating elsewhere. As Washington writes the rules, the whole world is watching, and the competition is fierce. Fourth, stay alert for legal challenges. Major financial reforms in America often end up in court, with companies, states, and advocacy groups battling over the details. The Supreme Court may eventually weigh in, shaping the rules for decades to come. Every step of the way, expect headlines, volatility, and fierce debate. And finally, don't overlook the political angle. Crypto regulation is now a wedge issue in national elections, with candidates from both parties staking out bold positions. Former President Trump's involvement shows just how high the stakes have become. Whether you're a crypto enthusiast or a skeptic, your vote and your voice can shape the outcome. So to sum up, America stands at a crossroads. The Genius Act, the Clarity Act, and the Anti-CBDC Act are more than just legal texts. They are the blueprint for the future of money, privacy, and innovation in the United States. If enacted, they could unleash a new wave of growth and trust in digital assets, but not without real risks and hard trade-offs. Innovation may boom among well-funded players, but smaller startups could be left behind. Privacy may be protected, but only at the cost of bypassing some of the most advanced payment technologies. And the US could either solidify its leadership in the world's digital economy or watch it slip away. Here's the practical takeaway for you. Regulatory clarity is critical, but it will not come without growing pains. Pay attention to which companies adapt, which tokens survive, and how quickly lawmakers respond to the relentless pace of technological change. Whether you're an investor, an entrepreneur, or simply someone who cares about the future of money, you have a stake in this debate. Now is the time to get informed, get involved, and make your voice heard. And remember, this is not just an American story. As Washington debates, Beijing, Brussels, London, and dozens of other capitals are watching and competing. The next decade will decide not only who leads in crypto, but who writes the rules for the next era of global finance. If you found this deep dive helpful, smash that like button, subscribe for more expert analysis, and let us know your thoughts in the comments below. How do you think these new rules will impact the future of money? Will America set the global standard, forge a new path, or let others take the lead? Stay tuned for our upcoming special on the state-by-state crypto race and what it means for you.